According to the German insurance company, global natural disasters have become more common in recent years. For example, there was an increase in natural disaster from 400 in 1990 to 820 in 2019. Evaluate the microeconomic effect of an increase in the number of natural disasters. Include at least one appropriate diagram in your answer. For what is microeconomics? Microeconomics discusses the individual market within the economy. Then when we talk about natural disaster, these are things that are beyond the control of any economic agents. So here I wrote, natural disaster includes tsunami, flood, earthquake, and so on. So according to the extract, there was increase in natural disaster from 400 in 1990 to 820 in 2019. This will affect both the PPF and the supply of goods and services globally. So firstly, let's talk about supply, which is the number of goods, the quantity of goods firms are willing to produce at a given price and time. So an increase in natural disaster will affect the supply curve, shifting the supply curve leftward or upward from S to S1, and as a result, the quantity supplied of goods will contract from QE to Q1. That's about supply. So the graph is there already. This is the graph representing the supply as a result of natural disaster. Then an increase in natural disaster also will affect output. That's GDP now. Will affect output globally. This implies that the PPF is expected to shift inward from PPF to PPF1. From PPF to PPF1. This can be graphically represented as this. So an inward shift from PPF to PPF1 due to natural disaster. Then according to the case study, increasing natural disaster will reduce the number of insurance companies available, as few ones may be able to survive it. Mostly those that will survive are the ones far away from where the natural disaster occurs. So this will in turn increase the demand for insurance, as economic agents may want to cut their losses by insuring their businesses and property. This will shift the demand curve for insurance rightward from D to D1. As a result of that, the quantity for insurance will increase from QE to Q1, bringing about a rise in price from PE to P1. So that's for the demand curve. And lastly, I said, however, through subsidy, this will in turn government might intervene. And by intervening, the government might subsidize. So we seeing the price of insurance increasing. With subsidy, insurance companies would have cut their losses, their cost of production would have fallen. As a result of that, the price for insurance might as well fall. Is it clear? So that ends economics paper 1.